All right. Hey, welcome everybody. So today we're going to be really diving into M&A. I don't expect any deals to happen today, okay? So just to set expectations. If it happens, great. But I think we really just are here to learn, to get familiar, and to check in. It's been wild out there. We consider this space somewhat of a sanctuary, a protected space, a place for you to chill out, absorb, hang out, and learn from one another. My three guests today are very well versed in what we're about to discuss. And in the audience, we have, in my mind, warriors that have been battling and pushing and grinding every day. So hopefully you can just take a chill, absorb, and hopefully be open-minded and curious. We have a bunch of questions we're going to go through and hopefully give you a good lay of the land of how to think about M&A in this particular panel, which will then break for lunch, which it's going to be great. And then after that, we'll have another panel. And feel free to smoke. There's some joints over there. There's a bathroom over there. We really want to make it as hospitable for you as possible. Cool. And just a shout out to Patty, Aria, Mickey, Lauren, and Jordan for getting this all set up for us and making such a good vibe. All right. My three guests, we have Kieran Ringgenberg, who practices at Ringgenberg Law. We have Joseph Devlin at Santillan and Devlin, SD for short. And then we got Will Dolan, who I've known here locally for a while, and dabbles in a lot of different things that you'll get to go through. Okay, so we're gonna get started. The first question is really around just like orientation. Kind of where are we right now? How are we feeling? What's your view of the space? What are you kind of seeing either in M&A or conversations, just to get a sense of your perspective? Because I think it's unique that everyone's sort of battling in their own sort of silo, and it may be helpful to get a little bit more perspective on the landscape and what we're all facing or a part of. And we'll just move it down. Does that sound good? And you can just chime in whenever you want. Don't need to be formal about it. Just a backyard hang. Cool?
Hi, everybody. I would say where we're at right now is fighting for survival. I think that's how I would summarize the state of the industry and most of the operators that I work with. The tap of incoming capital has maybe not been turned off, but it's definitely turned way, way down. And so the focus now is getting cash flow positive or at least neutral, figuring out a long-term path for a business that can make it to the end of the quarter, the end of the year. And past that, I think that on the M&A side, a lot of what I'm seeing is what I would refer to as salvage jobs, meaning there's a struggling business that might have potential but is in over their heads, new owners coming in trying to save the day. Maybe that's an adjacent business, maybe it's a new investor. And so it's a lot of cleanup. It's a lot of trying to figure out what the problem was and see if there's a viable business there going forward. I think the other thing I've seen a lot of lately is people looking for dance partners. So maybe it's a production company that wants retail, or maybe it's retail that thinks they can do better if they had integrated production. And so maybe there's not a lot of cash involved, but they think there's synergies in putting the pieces together, or expanding geographically. We're like, hey, one store doesn't do it. If we had 5, maybe it's making more sense. And so I think that's where we're at, and I suspect that's where we're going to be for at least the next couple of years.
You guys have mics.
Oh, very good.
All right. Check, check, check.
I think you're good.
Check, check. Check, check. Okay, there we go. All right, thank you. Well, thanks, Kieran. Everyone can hear me okay? Yeah, good. Okay, cool. So, yeah, I agree a lot with most of what you're saying. So, from my perspective, the market is starting to normalize, right? And I'm using that in perspective to my experience prior to Cannabis, which was in working in the hospitality field, advising on hospitality transactions, working with bar restaurant and hotel owners, and being familiar with valuations in that industry, having to raise capital in that industry, and just transactions generally. And so a lot of people may be surprised kind of what's been happening in the market with cannabis, but to me it was expected. Where in 2017 to 2019, I think I consider those the 2 years where decisions were being made in a very speculative fashion. They weren't based on numbers. They weren't based on, like in the retail world, they weren't based on locations of stores. Valuations were, based on speculation and based on the land rush or green rush and just trying to lock down licenses and trying to get a foothold in the industry, not based on the fact that these stores were profitable or that they had long-term potential. It was what I call people investing with funny money that didn't really make much sense at the time. And I've always known that was not sustainable. And now we're starting to see that. And that's not necessarily a bad thing. It's just reality setting in that numbers matter. Looking at financial statements, profitability matters, scalability matters. If it's a retail store, for example, does the brand have potential to be scaled? Do the locations actually make sense? Is this a location that gets a lot of foot traffic? Is it an active location? Is it or are these stores in an industrial zone, right? Or somewhere where there's not going to be a lot of foot traffic? So these are the things that people weren't looking at as closely as they are now. And now all these details matter. So it's not necessarily a bad thing. It's just cannabis as a business, especially in a retail world. Most of my experiences dealing with retail businesses, these metrics matter. So this stuff needs to be considered before starting a business. It definitely needs to be considered in an M&A situation. So I don't think it's bad news. I just think it's a dose of reality, and it's cannabis becoming a more normalized and traditional business, just like everything else. So
I think all of that was very well put, and maybe just to build on the kind of the fundamental business issues that Will brought up. I guess I've seen some, what I would describe as anxiety amongst a lot of business owners as they're trying to, I think, understand what their value is, and maybe questioning their business model and their long-term sustainability, while you have some other groups that are maybe still looking to invest and acquire, but they are really drilling down into those business fundamentals, and that's where I've begun to see kind of the separation or misalignment, if you will.
Maybe I'd love to maybe just talk about the players in the space. Now that we kind of talked about sort of what we're operating in, let's talk about who's here. Especially because we have such a mix of players between legacy, transitioning into traditional, new operators getting licensed today, basically doors opening now, to people that have been operating for a while and maybe trying to make the numbers work. And then we'll get to the next thing.
Well, I think you laid out in broad terms, which is there's folks who've been in the business for a while who maybe had a viable economic business, and it's transitioning into the regulated system. And as that evolves, with some increased competition, a lot more rules, a lot more taxes, a lot more compliance issues, you have at the complete other end of the spectrum are the national MSOs, which are small in number, and at this point not terribly interested in California, because it's a really competitive market and there's no money to be made here in their perspective for the most part. And in the middle you have people that have either started in or after 2018, or folks who have substantially changed the business they're in. And there's quite a bit of that, because in the early stages, a lot of people were just grabbing what opportunities they could. And then now kind of the game of musical chairs is over, and people who had 4 or 5 businesses ongoing, they're gonna pick the one that has the best legs and stop with that. And I've experienced that a lot, where someone's like, hey, I got one business that's working, let's fund these 3 new projects. And then the original business that's spitting off the cash doesn't make it. two of the three didn't make it, but they landed on one good idea, or maybe one good execution. Maybe they just happen to have a better lease for that business than the others. Could be anything, right? But I think that's kind of where we're at. I hand you my.
Yeah, and just to repeat a point that you said, I think, in talking about the players in the space now, it's definitely a different landscape than it was in the two or so years prior to COVID, when things were all just getting started, preparing for permitting that started in 2018 and licensing here in California. And at that point, you saw all the MSOs, all the largest companies. Everybody was kind of here salivating for any place in California, San Francisco, Oakland, Los Angeles. And they were signing deals that didn't make any sense, signing leases that didn't make any sense, even purchasing buildings at that point in time, and all that has come to an end here in California. So there are some MSOs still kind of doing projects that have been kind of in the pipeline, but I'm not really seeing any new ones coming out here with any interest. And I'm also seeing MSOs default on leases and hand keys over and walk away from projects they signed up in 2018 and 2019 because they're realizing that it doesn't make any economic sense, right? And it's something that's going to be operating in the red most likely based on a lot of factors. So what I'm seeing now, I think, is the most active. I mean, besides just kind of upstart independent businesses, is these, what I call them more like regional operators, and some of the fastest growing companies in California are these operators that maybe have between 3 to 10 units in existence, and they're just scaling, and they're growing, and they're very bullish on the state of California because that's where they were founded. And they're like down in Los Angeles and up here in Northern California, there's a handful that are really continuing to add stores, continuing to open stores, and are just very active. So I think that's the difference, where we didn't have these companies back in 2018. There wasn't really any of these West Coast regional type operators that had 3, 4, 5, 6, 7 units. So the MSOs were kind of the main player. But right now, I think it shifted a little bit. So there are some companies doing well and really starting to really kind of scale in a way that's looking good on paper, and they're in good locations, and they have 7, 8, 9 locations in total. And so we're starting to see that, I think, right now is what's happening, and we're going to see more of that in the next couple of years. And those companies probably are going to be targets of MSOs when everything is all said and done, and they have a strong balance sheet and a P&L that is in the green and everything looks good. Then I think we're going to start seeing MSOs come back in 1 to 2 years from now.
Well, we either have the same exact view of the world, of the landscape here, or we're kind of seeing the exact same thing. I have one client who is maybe more institutional money, has zero interest in California, and then my clients that are actively looking for acquisition targets in California that's a good way of describing it, kind of regional operators that do have an infrastructure, that have 6, 7, 8. Number of stores, and maybe they're vertically integrated. But that is where I also am seeing most of the activity, most of the demand around.
So we got the landscape, we got the players. Let's talk about the money. We've been, if we look at the last decade, in the last decade, there's been a number of funding vehicles and instruments for this industry. We've had multiple sort of boom bust cycles, multiple ways of, whether structuring your company in a corporation or securing equity, or now debt and then loans. Let's just talk about the current view on where the money is at the moment.
What I'm seeing recently is almost all significant financing is debt-based and almost exclusively based around real estate. That's the one thing that people are still willing to lend on. There's a little bit of funding to real estate adjacent projects. Maybe it's an operator with the option to acquire their property, and that's enough of a hook to get real estate investors interested. But for the most part, if you look at any of the large transactions that have been publicly reported in the last 6 months, every single one of them is a loan based on land at the end of the day. So I think that's where they're at. The other thing I do see is just private money in small to medium-sized transactions to acquire businesses or do roll-ups. And that's typically just going to be either private office money, meaning rich family money, unencumbered, or something that's made up of that type of money in some kind of fund or roll-up. I think that's what we have. I think I will say this. I'm hesitant to say it, but I'll say it anyway. The one other source of money in the industry is people who are making a lot of money exporting product outside the system and funding, either trying to get in the legal market or using it to expand their business that plays on both sides. I mean, I don't know what percentage of the funding coming in right now is that, but it ain't zero, I know that.
That doesn't happen. I mean, I would again agree with that. That is the folks that I'm seeing still investing in this came into this industry with, some amount of capital, or they've been kind of that regional operator that has grown and really found some success and still has positive cash flows and is maybe still then also attracting some investment capital. California is it's because of all of the licensing complexities and the tax complexities with the state, we still have the big institutional money really sitting on the sidelines. And so I don't think that's going to change for the next couple of years. So I think it really is going to be kind of like this patchwork, hodgepodge collection of, smaller family office money, successful operators, organically growing and expanding. And it's going to take a few more years before I think any institutional money comes back into the state.
I second everything you guys just said. So, I mean, financing is something that I don't have a lot of experience with, so it's a little bit outside of my area of expertise. But what I do know is right now I agree that the financing markets are extremely difficult. There's not a lot of capital, and there's a lot of capital on the sidelines, right? But there's a lot of wait and see happening, and it's a challenge, I think, even just to raise money on a small project from as an individual. But there are, like you said, I think small family offices, high net worth individuals. It's just a more kind of grassroots type approach to financing, I think, is what has to happen right now. Because I even in the real estate world, there were several multi-state banks that were lending on cannabis real estate projects here in San Francisco and in Oakland and in Los Angeles that have now backed out, right? And so these were banks that were actively in the space that have now decided they're no longer in the space, and so I'm seeing that type of stuff happen. I've also seen a couple new banks enter the fray that are kind of smaller, not that are multi-state, but more smaller regional banks as to these larger ones that were doing, the few that were doing cannabis transactions 2 or 3 years ago. So from a banking perspective, hopefully this is all short-lived because safe banking, knock on wood, will happen this year. Yeah, so that's all I really have to say about that.
I think just to Kieran's point, though, like the real estate piece is so important to any deal. I mean, generally, it's the first or second question I'll get about a potential, acquisition target is, do they own the building? Does the property come with it? Is it an option, right? And if the answer is no, no, and no, it's generally like, well, okay, send me some information, but probably not.
And the relationship with the landlord is such a dance. Maybe walk through some of those relationships that you've seen, and what the path forward is in that case.
Someone want to go first this time?
Well, I think a big part of it comes down, if you don't own the property, like what are the terms of your lease, and how real tight is your lease contract. It gets back down to the business fundamentals and how much you can't overpay in rent because you're overpaying in taxes and you're overpaying for everything. So something's got to give, and real estate and rent is so foundational to a sustainable business model, that if you don't own the property, you've got to have a really tight lease that they're going to feel comfortable coming in.
100% agree with that. The commercial leasing is something that has kind of been one of my professional focuses for about 12 years, and so I've done about a dozen cannabis leases here in San Francisco, from leases with individual equity applicant operators all the way up to leases with publicly traded MSOs and everything in between. So I've had a very good, I have a very good picture and snapshot of what the leasing market looks like in San Francisco. Now, in San Francisco, there were leases getting signed up in 2017 to 2019 that were probably 2.5, 3x what the market lease rate should be. And those leases are falling by the wayside. If they haven't died yet, they're probably in the process of dying now. And so, that it's incredibly important to have a lease that it doesn't necessarily need to be market rent, right? Because there's a lot that goes into entitling cannabis and finding a property that works for cannabis. So maybe a cannabis lease is a higher lease rate than a restaurant, right? But it doesn't, 2.5, 3x, like as an example of a lease, the worst case scenario is like this lease in Union Square, and we had discussed this a little bit earlier, that was signed up by Have a Heart back in 2018. It was transferred to Harvest to Arizona, I think in about 2020 or 2021, and then it was packaged up in some crazy M&A deal with High Times. And if you've been paying attention to the media around this project, the owner of the building, which is Store Equities, which is a landlord that's very established, New York real estate landlord, is not someone that's going to cut a deal for you, and someone that demanded a very high price for this Union Square asset. And I think the rent was well over $200,000 a month. And now the operator defaulted, and the landlord has a suit against them for $5 million in back owed rent. Well, obviously that project's dead. I mean, it was dead the moment they signed that lease, And so that's the type of stuff. In an M&A deal, where Harvest and Have a Heart and High Times. I mean, it was like a circus car, basically. I don't even know what happened in that transaction. And the company Have a Heart, I think, had 5 leases in San Francisco that all died. So they struck out on all 5 of them because they were signing leases that were 2 to 3 times market lease rate, and none of these projects saw the light of day. Every single one of them died, right? So, and somehow this stuff was packaged into an M&A, with Harvest. So, these are the pitfalls you need to avoid. And the landlords got screwed on all those as well. So everybody lost in those situations. The landlord made a bad decision working with these companies, didn't vet the people behind these companies, right? They were folks that were signing deals up and down the state without any intention of performing, solely to try to flip the projects, right? To try to create some artificial value, and then oh, I'm going to sell my 5 stores for $100 million and walk away, and there was nothing behind it, right? This is what their intention was, and it was an unsuccessful strategy, right? So. Yeah.
I guess I agree with all that. I would just add that a key factor is what's the next best use for the property. Owning a building where a cannabis tenant leases is a hassle because your financing is significantly more expensive on the building than it would be with any other business. So no one would do it if they're not getting a premium return. It doesn't make sense. And if anyone asked me, I'd be like, you absolutely should not rent to a cannabis tenant at market rates because you're tying your hands over how you can finance your building. And so you have to try to consider that. In San Francisco, every real estate is valuable. There's no such thing as useless real estate in the city, but in other places there are. So if you can find a building that doesn't have a great alternative use, then the ability to acquire or lease that site is significantly improved. And even crazy 2018 leases can be revisited if you convince the landlord that there's no future at this rent rate, but you can still get a premium return if you agree to something that's a little more reasonable. And I would say I've spent a ton of time in the last year having that discussion again and again with landlords of like, you want this guy to stay, you got to lower your rent or he's out of business. And then you're going to get 30% or 50% of the rent from someone who's non-cannabis. What do you want to do? And some landlords are willing to negotiate and some aren't. If the building's been sold on the assumption of the high rent rate, you're probably SOL. But if it's a reasonable landlord who has common business sense, then there may be something to do to make that work out.
All pieces of the puzzle. Okay, we got the landscape, the players, the money, the real estate. Something that we were talking before this was really about what we call the front end and the back end. How you set up a project to be successful from the get-go. What does that look like as it plays out? Or if you didn't necessarily set it up for success and you're on the back end of it operating, what is a way to sort of inject some vitality back into it to move it along? Because now we're dealing with a mixture of different operators at different stages with different cap tables, varied financing, but still trying to figure out their path forward.
Anyone want to take that first?
Maybe Will, why don't you start off on sort of how you think about it on the front end?
Okay.
Yeah, I think that would be great.
Sure. So one of the things that I always do, is because I work with a lot, like when he's talking about front end, back end, I work with a lot of folks on the front end of the process, folks that are kind of looking for, and this is going back about 6 years since I started focusing on cannabis. This is from someone coming up with an idea and having a business plan and saying, hey, I need to find a property, for my business, and then I need to find some partners, and we need to put together an operating agreement for our LLC and kind of like what their vision is, right? And if it's a one-off store, it's a one-off store. Like M&A considerations aren't necessarily a big deal, but a lot of folks kind of have vision to scale their business, vision to kind of expand, maybe vertically and horizontally, right? And they want to be able to kind of set the stage for what's the 5-year exit strategy, right? And whether it's an M&A or whether it's a public listing, a lot of people have been thinking about this. So what I've done is just work with them to try to create a platform to prepare for M&A in the future, right? To prepare a business structure that's clean, that will be alienable, saleable at some point. And obviously, there's a lot of regulatory hurdles involved in this conversation, especially in a jurisdiction like San Francisco or any of the other jurisdictions where there's an equity program, like in Oakland or Los Angeles. There's all these regulatory requirements in order to complete an M&A. And so some of the stuff that we're doing now, maybe an M&A wouldn't even be possible based on the regulation, but you can set yourself up for success in the future. And that's even from thinking, just say you're operating an individual LLC and you're planning to scale, thinking about how to keep that LLC minimum with the minimum number of members, right? And maybe holding the interest in a parent corporation so that the LLCs on the front end that are operating the businesses are owned by, say, a C Corp, for example. And then the C Corp is where you focus your M&A potential. You try to focus on the C Corp owning, the cultivation, owning the retail, and each of these operations are individually held, and keeping the number of members to a minimum on the front end, right? And having the investment on the parent side, right? So this is the type of structure that I've been recommending and helping people put together over the years, and I think probably the best way to set yourself up for success in the future. And one more quick point. The regulatory stuff is so important that the way I've been approaching the process is before even signing deals, I run stuff through our local office of cannabis here to get feedback, because initially we weren't doing that, and sometimes we had to amend the deal documentation 4, 5, 6 times, right? And costing people, the amount of money it costed and lawyers' fees and everything else doing it that way, we learned our lesson, and the lesson was get kind of a thumbs up before you start signing deals and doing deals, and disclose everything, because I'm now dealing with situations where folks didn't disclose certain things to the Office of Cannabis, and now 2 years go by and they're trying to do something else, and you're having to disclose old documentation, and that's creating a whole new headache for folks, right? So disclosure and regulatory compliance on the front end is extremely important, and it can blow deals in the future. And on the back end, in an M&A sense, what you screw up on in the beginning can blow a deal down the line. So,
100% agree with all of that. The folks that I'm working with that are acquiring businesses or looking to acquire, they generally have a business plan and a model, and they know what they're looking for. On the folks that are maybe looking to exit, that process I think has been a little bit very much different. And I think one of the things that I've tried to do with business owners is get them to think about value and not just the dollars, but if you're going into make an exit, you really need to think through, what do you value? What are you looking for in this exit? If it's just dollars, okay, you might be chasing something that's not going to be a great fit. And ultimately, in an acquisition and merger, it really comes down to about fit and integration and also why you're doing this, because that drives so much of the value. There's so much more about selling your business that you've dedicated years of your life to than just than just dollars. So I really encourage folks to kind of work through a process of identifying what is valuable to them, because you're going to have, 100 decision points that are going to affect value along the way, and you need to really kind of distill what are those pieces that you value. Is it going to be how it's going to be operated? Is it going to be in maintaining the name? Is it going to be in maintaining the employees? Is there some elements of your legacy of the company that you want to see carry through, or are you just selling the license and taking the exit? So really kind of getting to the, what they value at the front end of that process, rather than kind of entering it as to what people might make a dollar offer for. Each one of these deals is so bespoke. There really isn't just a template that you can just overlay and say, well, this is how this deal is going to happen, and this is how this is going to go.
I agree with that, and I would echo the sentiment that you really, if you're trying to position your company to find a merger partner or be acquired, you really got to put yourself in the mind of your potential acquirer or a merger partner and ask what they're going to value in this transaction and focus on that. There was a time when it was a viable business plan for a cannabis business to get a license and figure out later how to raise the money and get an operation. And that's like dunzo. That's over. So now we're at the time where whether you're at the beginning or in the middle, you need to make sure you have a plan to survive without additional fundraising, unless you have a very secure source of funding that you can rely on. Because the days when you could say, I got 3 months and by then I can raise some more money and it'd take me over until someone buys me, I don't think that's just gone, right? So the other thing I would add is, there are some businesses where the value is really just the license. There's not really anything else there. And if that's the case, you should really be managing your business with a strict eye to the bottom line, because the debt that you're accumulating is just going to cut against the value you're going to get for the license. Because if most likely in most jurisdictions, you got to take the legal entity that holds the license, and that means you got to take all the debt that comes with it. And if you've run up a big bill, that's got to get paid before the owner gets a dollar. And so, it might seem great to make these investments, but if there's not a business plan to get a return on that investment, you're better off running it at absolute minimum until someone buys the license. That's not a great business, right? But there are predatory lenders in the industry right now who are cutting these deals where they're charging 30 or 40% interest on short-term loans to desperate cannabis operators, and it's a death spiral that ends really quick. So I just want to, having tried to solve that problem for people who have already made the bad decision to take that money, I want to advocate to avoid it at all costs, because it's not there's not an easy exit from that situation.
Well, yeah, that is, I think, one of the first things that kills a deal is tax liability. It's like, somebody wants to exit, somebody wants to buy, great. Think we have a general agreement on price, start doing the due diligence, and then that number of for the offer goes down really quick. And it really quick, I mean, I've watched it kill a number of deals, and it's kind of painful because you spend months and months working on these things, and then inevitably it just falls apart because the tax liability is, 50%, 75% of gross revenue, and back to your business fundamentals, the business is really in a death spiral, and the investor or the person looking to acquire says, well, I may as well just wait. Right. I don't need to buy this now. I can call you up in a year from now, and you won't even be around, or I've watched people just hand over the keys, right? Acquire the company. People basically acquiring it for the debt. Just let me walk away from this. I know that there's at least one in the Bay Area that was recently just went through that exact deal. And so managing the bottom line is so important, and being aware of, are you digging yourself into a tax hole, because that will just cuts right across your valuation.
Taxes, they're too high. Way, way too high. Yeah. One of the things we also try to frame here is, all right, getting through these next couple years, what does a light at the end of the tunnel look like? What are some of these scenarios that are catalyst events that improves the value of that asset to a point where you are willing to exit at what you expect? Just to lighten the mood. Is that cool? Then we'll go back. But let's just look optimistically of kind of where we're at, because to me, it still feels early. I was hanging out with a group of friends the other day. We were smoking. They had no idea what brand, what flower, what strain. They just liked it. And I'm like, come on, guys. Like, we hang out together. You have to at least be knowledgeable. So I think there's still a huge gap that we're seeing in the consumer side. But yeah, let's talk about that.
I guess I can see three. One is the floods carry off a lot of the chaff, and the survivors that are left have a real business that could make money. I think that's going to happen. Maybe a while, but it's going to happen. Two, we get federal legalization or something like it, life-safe banking that opens up the door to real finance to get the institutional money off the sidelines and into the business. And then I think you're going to see some rapid roll-ups, and these big companies are going to steamroll. But if you're in the roll-up, that could work out really well for you. And the third is someone has a real unicorn of a unique business. Maybe it's their location. Maybe it's a brand that has something truly extraordinary where you could make a killing in the current environment. And with the exception of retail in a truly extraordinary location, the number of folks who are going to pull that off is probably real low. I don't be a bummer, so let's focus on the first two.
All right. Well, for the next 2 years, I think it's like any market, especially in its infancy, like cannabis, that it's going to go through growing pains, and so I think that's where we are right now, where fundamentals really matter, and I think all operators, whether it's retail or some other use within the supply chain, really need to focus on their fundamentals. Really need to focus on getting costs under control. Really need to focus on trying to create or trying to maintain something really unique, because competition is coming, right? It's here now, right, obviously, but real competition. Like, competition to me is, I relate it to the restaurant market, right? In the restaurant market, it's the most competitive business market in existence, right? These restaurants have like the highest rate of failure of any business out there. because it's extremely competitive, right? But some restaurants are killing it, some are just surviving, and a lot fail. So it's similar to that in a sense. You really have to focus on differentiating and trying to stand out amongst your peers and amongst the crowd, because it's becoming a crowded field, especially here in San Francisco by the day. You know, we're hearing about new stores opening. We're still getting applications coming into the pipeline here. So all these things really matter. And I focus a lot on retail. So so a lot of what I say is mostly retail related, but it's for all cannabis uses, you know, and especially with retail, location matters. You know, marketing matters. What you can do to offer consumers an experience beyond just products, because everybody has the products. You can get the products delivered in 15 minutes from 25 different delivery services at any given moment, right? So why am I going to go, you know, out of my way to go visit a store maybe that's not in my own neighborhood, or why am I going to do, you know, something that's not just for pure convenience? Well, there has to be something else there. There has to be an experience there. Consumption's a big part of the retail market moving forward. You know, and just the next 2 years is really about trying to stand out and trying to weather the storm and preparing for a very competitive market and acting like this is any other business, treating it just like any other business, and not thinking like I'm gonna throw a sign on outside and turn my lights on and then I'm gonna have a line out the front door. That's fantasy. You know, that's long gone. You know, years of the past. So, but yeah, act like cannabis is any other business. Be prepared for an extremely competitive market, and you know, I think the folks that weather this storm are going to come out on the other side and be in a great position, especially from an M&A perspective, because I think there's a lot of folks waiting on the sidelines, waiting to see who gets through these challenging times, who's going to be there on the other side. So I think that's what the focus should be for the remainder of this year and for next year. So
On the production side, I'm still very optimistic about California as a brand. The minute that we get interstate commerce, I mean, I imagine it's just going to be like a fire hose spraying weed across this country. I mean, that's what we've been doing on the illicit market for the last 50 years. And I think there's a cachet to California. On the retail side, I believe we will get 280E reform. I'm not sure when. I'm probably less, you know, I still think we're a couple years away from that, personally. Hopefully it comes sooner. But if you can survive the next couple years and you still have, you know, $3 million, $4 or $5 million in 280E debt racked up, I don't think the federal government is going to be like, well, you know, we're going to waive that. I think you're still going to have those liabilities. So I think it really is going to be like, are you going to be in a position, and once that happens, you know, to be able to grow your business, you know, in a more traditional environment where you're not being held down by 280E, but you're going to have to be able to survive up until that point.
I mean, 280 would boost the bottom line, what, 20%, 30%, 35%, 40%, 40%. Yeah, absolutely. I mean, it's a terrible burden. I think the other question is, like, how much will the government take if there is interstate commerce or legalization in that frame? There's still some outlying questions there. But okay, so we got the landscape. We have a light at the end of the tunnel of where things go. Like a colleague of mine that I was speaking with the other day was like, he alluded not as a flood, but as like a fire. And you know, it's gonna burn away a lot, but the ones that are left will be standing and will be hopefully thrive with the extra sunlight. Another analogy was like, the strongest steel is forged in the hottest furnace. I was like, I like that. I'm gonna take that because it is pretty crazy. So let's kind of dive in now into the actual journey. All right, I'm gonna prepare for a roll-up or a long-term partner. I'm a current operator. I'm thinking about, you know, who my dance partner is going to be. walk me through sort of like the milestones or the things that we need to go through so everyone can kind of see like what the path ahead looks like. It's like the yellow brick road. Like, show me where we get to Oz and where the flying monkeys are, and we'll go from there.
Well, this is gonna be interesting because we didn't do any prep for this. We'll see how we kind of go sequentially. I think one of the first things that if folks are looking to make an exit is kind of again back to that value, and establishing your what's called a BATNA, your best alternative to a negotiated agreement, and if this falls apart, then what, right? What's your fallback plan? And sometimes that's very easy to identify. Sometimes that's very easy to quantify. Sometimes you just know it inherently. But establishing that BATNA, best alternative to a negotiated agreement, and if you don't have something that's clear, kind of setting what is maybe can be called like a tripwire of like what's your your yes or no point of like, okay, if I can't get this right, then I'm out, right? So establishing like those two things, I think are internally, I think one of the first steps.
I guess I want to start by echoing something that David said, which is about the strongest steel being forged. One thing I will say is California is the most competitive market in the country for cannabis. No question, hands down. So that means when we do have interstate commerce, our operators have already been through the ringer, and we're going to eat the lunch of those MSOs who only have 2 competitors in a whole state because they have no idea. And what they're doing right now is trying to set up regulatory barriers so they don't have to compete with us, okay? So if there's a light at the end of the tunnel, in my opinion, that's it. So, I'm sorry, let me go back and answer your question, which is, I think there's 3 things, if you're trying to position yourself for acquisition, 3 things to focus on. One, and the most important, is your business fundamentals. If you don't have a business that someone wants to acquire, no one's going to acquire it. So, you can put lipstick on a pig, but the most important thing is, does this business make sense? Do I have something that someone would want to buy? The second thing is get your house in order from an administrative point of view. You need to make sure your tax returns are filed and professionally prepared. You need to make sure that your corporate documents are done and correctly organized, and you forgot to get the signatures from 3-year investors about what their term sheet was or whatever else. Just get your shit together, okay? And the third is get organized. The first thing any real investor or potential acquirer is going to want to see is the same set of materials, and we have a very good due diligence list that if you look at it, for most people is going to be really scary because it's got a lot on there that most people don't really have. But regardless, get all your information organized in some way, and the first time someone is really taking a hard look at your company, they're going to say, give me your data room, and you'll have all your stuff in like a Google Drive or a Dropbox or whatever you're going to use. And you can get that started early. And in my experience in cannabis, even with mid-size operators, people don't have that organized until they've been through this a couple of times, and they had to do it because someone asked them. So if you get started ahead, it's going to make everything go faster. You're going to seem more professional and accomplished and on top of your business, and it's going to just present yourself better and raise your price because they're going to see that you know what you're doing. At least you're going to fool them into thinking that you are.
All right, I just want to make a quick point. So one thing I think that's important is kind of thinking about the front end and starting businesses to prepare for an M&A in the future is to kind of look at this through in a jurisdiction like San Francisco. A lot of it you have to look through an equity lens, right? And look at our equity program and think about, a lot of these businesses here in SF, especially retailers, have an equity partner, right? So whether the operator owns 1 store or 3 or 4 stores, doesn't really matter, that they'll have a percentage of each of those stores owned by an equity applicant partner. Now, there's a lot of opportunity for equity applicants, I think, in these types of future M&As. And so what I'm seeing now, and some of the deals that I've been helping folks put together between equity applicants and operators, is the ability for that party, the 40, and San Francisco requires 40% ownership of the operating entity by the equity applicant, is the equity applicant having the ability to fold their interest into the parent so that then they can then take their 40% shares and turn it into shares in some larger parent corp, have some real skin in the game at that point, and then participate in the M&A, right? And so there isn't some type of segmented transaction happening where there's an M&A happening and only 60% of the operating entity is selling in that M&A. The M&A. The operating entity could be turned into a single member entity held by the parent. The equity applicant's interest can be folded into a parent corporation. They can stay involved, they can stay invested, right, and create some long-term value. And so I think that's really important on the front end is to set expectations. And some folks want skin in the game. They want to have long-term involvement, and they're not looking to just enter the business transactionally, right? And so I think from the onset, it's very important that the operating partner, the MSO, or the local operator, and their equity partner have expectations that are set and that they're all on the same page. Because I'm also seeing situations where there's potential M&A happening and the equity partner is not participating and not contributing to it, and then it's an impossibility for these deals to proceed based on the original deal documentation. So M&As are not happening now because of a non-cooperative partner, and other ones I think that have potential because the partner wants something bigger and wants some long-term involvement, and they see value in that. And it's important for equity applicants too to look at their partner, because a lot of times maybe there isn't value there, and maybe they don't trust their partner, and that's why they don't want to participate in the M&A. But in other situations, the partner is doing the right thing and doing a great job, and everyone's going to benefit, from working collaboratively. So that's a lot of what I'm seeing on the front side, and that's what I've been trying to ensure when people enter into these deals together, that that they all play nice with each other, so that an M&A can happen in the future. Yeah.
I think once you've started the process, or you've made a commitment, you maybe found your dance partner, if you will, that due diligence piece. One, to Kieran's point, I think you need to do the due diligence on yourself first. You've got to get everything in order. No one's going to have a serious conversation with you if you've got 3 years of unfiled taxes and a bunch of papers just stacked up in the corner. So do the due diligence on yourself first, but that due diligence piece is so important. Both what they're going to kind of look at your company, but you need to also do the due diligence on who's buying your company or who you're looking to sell to. I've seen a lot of offers that include stock. It's like, it's worth $1.25. Okay, again, it might be, but what is that based on, right? Kind of back to these fundamentals, and okay, now you have to do enough due diligence to actually value their stock. And so any deal that has that is stock or has I'm seeing a lot of seller carries where someone's looking, they'll give you 30, 40, 50, 60% now, and the remainder of funds over a period of time. That again, you need to be very good about your due diligence around who this person is, how capitalized are they, what does their business model really look like, because if you're not getting all of your money up front, it's really a hope, right? So what you're really getting is what you got in that moment and a hope that you're going to get paid somewhere down the line, or if it's stock, a hope that it's still going to be worth something. You might sell your business for $7 million, 5 of it is in stock, but when that stock drops by 90%, you essentially, got very little.
Speaking about the buyer, what's the best practices in vetting the buyer or vetting the partner so you don't feel like you're spending all this time divulging all this information and not getting anything of value from that conversation? By the way, we do have a document. It's a due diligence document. It's completely, it's pretty comprehensive. It's from Clark Howell, who's my lawyer, and it's something that we went through ourselves with our distribution license. We didn't end up selling, but it was an exercise in going through every single piece of document and getting familiar with what you have in your hand, and cleaning house if you don't, or figuring out where that information is. And then ideally come up with a plan where you can kind of tackle the areas where you have some work to do. But let's talk about the buyer, and let's talk about price. Those are probably two looming questions that we want to have some sort of parity on. Gone are the times you're saying you just had a license and figure it out later, or top line revenue, or multiples on top line revenue. What's the realistic viewpoint of the market? What are the numbers people are looking for? Is it more about sort of Ebitda or revenue multiples? Is it some of the value pieces you're talking about? So, like, valuing the buyer and valuing the price and seeing how you go from there.
I would say that the pricing in the current market is too idiosyncratic to give you any answer that is going to be meaningful. And it sounds like a cop-out, but it's just the truth. I do think it's clear that the days where the valuations are based on top-line revenue are over. But what is the new answer? Probably something where you look at someone's, cash flow or EBITDA on a projection basis. You're like, what's this business going to be doing over the next 3 years? And how much money am I willing to pay to acquire that profit stream? I think that's the basic analysis, but it bears only a tangential relationship to last year's financials because the industry is changing so fast. You have no idea what you're going to do next year because, we have 2020 COVID, and then we have like a period of crazy inflation that we're in right now. Like, if I was a financial analyst and I was looking at a 5-store retail chain and trying to assess what I thought they were going to do in 2023, it's really guesswork, right? There's really no way to know because everything's changing so quickly. So it's really what are the alternatives to the acquisition, and what are those looking like? I think that's really the only assessment. Let me step back and say, setting aside the price, what could the deal look like? And it's pretty simple. You can get cash, and if you have a cash buyer, your diligence can consist of show me the money, because after that, you don't really care. You could have debt, and if someone's acquiring your business substantially in debt, you really need to take a hard look at what expectation they're going to be making or acquiring enough money to make the payments over time. And a lot of times it's a shell game where they don't have the money, but they're expecting to sell their business and use those proceeds to pay you, which you can probably guess what my view on that arrangement is, right? It's not positive. And the third thing is some kind of equity consideration. And in this market, there's just a lot of business combinations where it's not really an acquisition. It's really pieces of a puzzle together. And then it's trying to assess what's the relative valuation of the two businesses so you can know who are the owners are going to get what percentage at the end of the day. And that's kind of, you have to go in that same analysis of like, okay, well, this piece, what are the other things on the market and what would they cost, or what have similar things sold for recently? That puts a tag on it. You put them together. So if one business is worth 10 million and one's worth 15, presumably the guy who adds the $10 million business is going to get 10 over 25% and vice versa, right? And there's a black science to that valuation, but at this stage in history, looking at other business combinations and sales that are as close in time as possible is the best means of valuation that's available.
All right, so a couple things on valuation, points I'd like to make. I think, similar to other types of businesses, even similar to real estate, one thing that I do and always recommend people do is to start looking at comparables, or I call them sale comparables, or they're comparable transactions, right? And whether it's a single store or whether it's a package deal like an MMA that includes multiple stores, or maybe some vertically integrated businesses, all inclusive. That's something that I use as a way to kind of set parameters, set guardrails. I also like to use the terms floor and ceiling. So you can kind of look at what's the pricing floor, what's the pricing ceiling, and you start there. And also, as a caveat, you can really only look at post-COVID transactions in this sense. You can't really look at, you got to write off what happened prior to 2020 because it's just not the market we're in, so it's not relevant. So you can say, hey, we look at all these sales that took place here. This is the value they were getting back in 2019, and it's not relevant to the conversation today. So I generally start looking at comparables, and there's not a lot of data out there with cannabis. It's not like real estate or some other business where there's a database and you can go look at, okay, in the last 12 months, here's 100 comparable transactions, and you can pretty much say our project is probably worth within a 10% range of where these other transactions are trading, and you can come up with a number almost like an exact science, like what an appraiser does when it comes to real estate. Can't really do that in cannabis, so there's very limited data out there. But if you use that as kind of the foundation, and then you start getting into the numbers. And I think the easiest way to start is to look at revenue multipliers, right? And you can look at what projects were trading at back in the early days prior to COVID, and then what they've been trading at in the last couple of years, And I'll just kind of share some of my kind of what I've seen out there, and this is like not just what I've seen firsthand, but also kind of just tracking the media and the news around this. Is that and listening to folks not just in California, but reading about stuff that's happening in other states as well. You were looking at, like, prior to COVID, 2 to 2.5x revenue was a very common, you'd hear transactions happening all the time, not even on existing revenue, but 2 to 2.5x on projected revenues, right? And sometimes even 3x, right? And so now what I think, and this is from also talking with VCs and talking with folks that are still actively investing in a much more conservative way. They're looking at revenue multipliers probably in the 1 range to 1.5 if there's, like, I view this as if there's just operating stores without really much scalable value, no strong brand behind them, it's going to be probably on the lower end, so probably about a 1 revenue multiplier. But if there's some other value, some ancillary value, like a strong brand, there's something that can be scaled out beyond just that individual store, then you're probably going to be looking at a 1.5x, or somewhere in that zone. And this is very general, it's very fluid. This is just kind of my, thinking about, what the market is telling me, because I always tell people, like, the price or the value is not what you think it is, it's what the market tells you it is, right? So the market determines the value. And so that's where we are. So there's no way to predict value in a sense, but you can look at these parameters to set your expectations, right? And then if you're a seller, you take the highest position you can take, but you have to be reasonable, because if you came to market today and say, hey, I have 3 stores and they're doing $20 million a year revenue and I want $50 million for my business, someone's gonna, they're gonna hang up on you, right? They're not even gonna take you seriously. But back in 2018, 2019, a 3-store portfolio would probably easily sell for $50 million, right? And now, not even close, right? So anyway.
Value is difficult. To the question about kind of the buyer, to the extent that you can get to know him or her, them, I would encourage that. I mean, in some ways, mergers and acquisitions are kind of like getting married with the intention of getting divorced. But when you finish the divorce, you got to be able to call up your former spouse, and they're happy to hear from you. I mean, this should go well, but it is a very intimate process. So get to know them. That would be, one advice. And then the value piece is really hard. Some of the proposals that I've been around recently are a 1x minus 280E liability, or just tax debt, which often doesn't leave a lot of meat on the bone. But, if anything above that, the buyer is buying it for, a 1.5 or, 2, start pushing that. And those deals just don't exist right now. I think kind of moving forward, I think we're going to start hearing more about Ebitda, and that's going to be more of the baseline metric of how things are going to be valued. And that, unfortunately, until we get 280E reform, that's going to be a tough, real metric. So I don't think anybody's really figured out what that formula kind of looks like. But I think it's going to shift towards that more traditional Ebitda, some multiplier of that, and maybe between now and 280 reform, it's going to be an Ebitda with something. And I think that something is going to be bespoke to every agreement, whether it's a strategic acquisition or how it kind of fits into that particular deal and how it creates value. So again, it's kind of like understanding your company and all the pieces that bring it value. Do you have intellectual property? Do you have certain geography? Do you have certain brands? All of that when you help understand what value you're bringing to the table, that also will help you define the value for the person who's acquiring your company as well.
Oh, absolutely.
So if you hear that businesses are being sold at a revenue multiple, the logical inference is you should run your business into the ground, lose a lot of money, but do a lot of sales. And I would suggest to you that's not a great business model, and that's the reason why revenue multiples are not the future of how these valuations are going to be done. I mean, it may be a factor, no question, but if you're basically operating at a massive loss in order to generate a lot of transactions, why would someone want to buy that business based on your revenue? It's made up, right? So, and that's a real thing that people have been doing in this industry, which is running businesses on massive losses to generate a top line to try to get a sale price. And if you pulled it off, I guess bully for you, but I don't think anyone sitting here today could rely on that. The other thing I would add, I agree with Joe that whatever valuation you get, the accrued tax debt has to be taken into account. And the same is also true of any other obligations you're asking the buyer to take on, whether that's accrued rent from your landlord, whether it's unpaid trade liabilities, whether it's CDTFA, taxes that they haven't managed to steal from you. Like all that stuff matters. You got to focus first and foremost on your business fundamentals.
And I totally agree. Oh, check, is that working? There we go. Okay. Really good point, and that's why I keep saying that fundamentals matter. The revenue multiplier and looking at comparables, these are kind of just set parameters, set expectations. But when it comes down to it, if the business is, say, losing $100,000 a month and you're $1 million in net operating loss every single year, your revenue multiplier is irrelevant, right? Because there's not really going to be a market for there's not going to be buyers looking at your business seriously at that point. So, I was just talking about kind of trying to set these parameters, and as you mentioned, I think Ebitda and bottom line is becoming more important by the day, and that's what we're going to be looking at a lot more in the next few years. So,
great. This has been great. How's everyone feeling about this? Yeah, really good job, guys. This is really important. Great wisdom. I guess for the last question, I'd love to hear I guess it's two parts. One, how do you see an operator in unlocking value? All right, we've been talking about value. How do we unlock it? What does it look like in terms of getting your fundamentals in order or your cap table in order, however you want to tackle that? The second is just any parting thoughts one thing I love about you guys can jump in and be the operator. You have that empathy, but you also have this perspective. Any sort of parting words on the strategy or the path ahead? So unlocking value and advice for, not legal advice, but advice moving forward.
Someone else wants to start?
That's a great question. I still think there's a tremendous amount of potential in this industry, and moving forward, I mean, I think we've said it a bunch of times, look at your real estate piece. Do you own it? What are your lease terms? Getting down to business fundamentals. I don't think that we're going to see, large influxes of capital, institutional money in this state for a period of time, maybe a couple more years. I think it's going to be post 280E, post federal legalization, which can be good because I think that may gives folks that are here a chance to maneuver. And I personally think that looking at the landscape, there's a lot of kind of ones and twos businesses, and if you can get your business fundamentals right, weather this latest storm. But I think that there's tremendous opportunity in the next couple of years around kind of building alliances and a network of companies, and maybe you haven't found your exit right now, but do you and like 4 other people kind of have the same vision? Are you all going to be ready around at the same time, and kind of can you build your little team of folks that are maybe willing to kind of present themselves as a package if you don't own 8 or 10 retail stores, but real estate, business fundamentals, and hold on to your hat because it's never-ending storm, right?
Yeah, and I also think now more than ever that certain things are incredibly important, and that's like branding, marketing, and really trying to differentiate from the competition. Because I know from talking with VCs and talking with smaller family office investors, that's the first thing that I hear from them is how is this different than the 100 other projects that just come across my desk? Or how are you different from your 100 other competitors that are doing the same thing that you're doing? Well, and the answer should be, we're not doing the same thing, and we're different in all of these aspects. And this is why our business is scalable and better situated than 99% of the field. And how do you do that, right? And it's different in every segment of our industry here in cannabis, right? Whether it's retail or manufacturing or whatever segment you're in. And I'll give this one example. Like when I talk about marketing, there's things that you can do that are invaluable. There's a local company here in San Francisco called Sunset Connect, and they put together gift bags for the Warriors, right? And somehow were able to connect with Warriors management and got each of the players on the Warriors championship team here the day before parade a big gift bag of their products. And then Forbes published an article about that this morning, right? About this local brand here in San Francisco and about the Warriors players, professional athletes, right? Which is another whole interesting conversation, right? Cannabis and professional sports, and then having Forbes write about it, right? Like how they orchestrated that and the value of it from a marketing perspective is invaluable. So this is the type of stuff I think that companies need to be doing to really stand out and to capture attention, because that's going to capture attention on a national level, because it came out in Forbes this morning and the Warriors just won the championship. So that type of stuff is what people need to be doing, being creative and really trying to stand out and trying to figure out how are we going to capture attention, the folks that are investing, that are looking to acquire businesses. And this is the type of stuff you have to do. So.
I saw a picture of Wiggins and Klay Thompson, which suggested strongly to me that they found those products. I would say you should focus like a laser on your bottom line, because if capital is hard to come by, the only way you're going to sell your business is you survive to the day when it can be sold, and the bottom line is how you get there. And so that has to be first and foremost at this stage in the cannabis industry in California. The second thing I would say is focus on strategic relationships with other businesses that you complement so that you can survive together in ways that make sense. And they also present natural combination partners if you're working well together. Because I do think it's going to get increasingly hard for the smaller players to survive solo. And so looking for, if you're a retail store, another retail store that's not in your immediate area that you can collaborate with, share marketing, share purchasing concepts. Maybe that sets the stage for a legal combination later. Or maybe it's with someone in production. But the people I'm seeing doing better have good, mutually supportive and healthy relationships with their important business partners. And I think that's essential. The last thing I want to say as a parting comment is, in my experience, our industry has been awash with unreliable get-rich-quickers, and I'm glad to see them go. And I think the people that survive are ethical, upstanding business people who can be taken at their word. And if you are that person, it's going to make it easier to survive because the other good players are going to want to work with you. And the people that aren't, who've been taking advantage and exploiting others for short-term gain, won't be able to make it in the long run.
Well said. You captured my heart. Well, this was very enlightening. Thank you so much. We really appreciate your energy here. Give a round of applause, everybody.